Okay, so what I want to show is just a really simple diagram of how this process works. And I'm going to use really easy numbers. I won't take the time to go through all this because you'll go through it in the pro formas after this, but we have a whole bunch of assumptions with what appreciation is, what repairs and maintenance are, how much the purchase price is, how much we're paying out of pocket, all those different things. But for the ease of numbers and to illustrate the principle, I'm going to say we're buying a house for $100,000. So we'll pretend it's our Indianapolis market because that's a price point that still exists there. And we're putting in $30,000 per house. $20,000 for a 20% down payment, plus we have some closing costs on a mortgage, we have some other fees, we have maybe a little bit of repairs and maintenance. So on average, we're going to say $30,000. So this just shows you a diagram of if somebody had $60,000 today, what we could do if we were buying houses for $100,000. And of course, if we buy in our other markets, the down payments are a little bit higher because the purchase prices are higher. And so it scales evenly. If you have $100,000 and you have 50 per house, then you can obviously buy houses that are $180,000 in Memphis, for example. What happens, you buy two houses. So we're saying on average, we're doing $275 a month. So year one, we cash flow $6,600. We put in $60,000, so we averaged about an 11% cash on cash ROI. Everyone follow that? Makes sense? So what I'm assuming is we put in money today and we don't ever add in new money. However, that managed principle that I talked about, we're real big advocates of unless you need that cash flow to put food on the table or to stay afloat, let's save it and reinvest it. You know, the principle of compounding interest. So let's assume that we save the cash flow, and this is our real estate business, and so we want to use the money for real estate. Okay, so year one, we've got $6,600 in our bank account. Not enough to go buy another house. Year two, year three, rents go up a little bit because rents increase every single year. So we get additional cash flow every single year. Now we have $30,000 of cash. Okay, so now I come over here to year five. And I know this seems slow and boring, but it's the way that we do real estate. It's conservative, it's predictable, and it works. And over a period of time, it's very, very, very powerful. So in year five, we buy house number 3 with the cash flow money. Okay, so we didn't come up with any new money, it's cash flow money. Now we've got 3 houses. These ones we've been increasing rent on. This one's at $275 a month because purchase price went up a little bit because of appreciation. Okay, the assumptions that we have in here. And then I'll just kind of fast forward to year 8. We have enough cash flow to now where we've bought 4 houses. Okay, then I come over here and now we've bought our 5th house. Again, still at the $60,000 investment. So what's happening right here after 10 years? We've got $2,000 a month of cash flow that we're accumulating, which is that $24,000 a year. Obviously, that's a significant cash-on-cash ROI versus the initial $60,000. So we're getting a good return on our initial investment. And here's the annual, okay, 10 years in, here's where I'm at. And my net worth, that $60,000 has turned into $263,000 of net worth because of the equity we have in our 5 houses. We've been paying down 2 houses for 10 years at this point. So we've been building equity with that, with the principal pay down, and the houses appreciate. Okay? I'm going to just fast forward. If you look here, year 12, 13, 14, we're basically buying a house a year with the cash flow. And I model this out to, well, I'll show you for 15 years. So there's our initial investment. Now we're at $4,000 a month. Our portfolio value, our debt, that $60,000 has turned into over $500,000 of net worth that we have. Then 16, 17, we don't pay cash anymore. And we can't buy a house every year because now we have 9 mortgages on our credit. So I'm going to assume the lending world is the same in 15 years as it is today, and you can only get 10 mortgages on your credit. So we're going to assume you have a primary residence, and now we have 9 investment properties. So now we have to pay cash. So we have to accumulate enough cash flow in order to buy this house outright. Okay? And I'm just going to go to 20 years right here and fast forward. So at the end of 20 years, we have 11 houses, 2 of which we own free and clear, 9 of which have mortgages. The first 2 have been paid down for 20 years, so there's not a very big balance on them. And that $60,000 has turned into $75,000 of annual income. And the net worth has gone up to about $1.2 million. Now, the first thing I kind of think as I go through this is everything looks really great on a spreadsheet, right? It's easy to make spreadsheets look really, really good, and real life can be a little bit different. And what does it look like? I'll be back up later tonight to just share some case studies of some actual clients that we've had for 5+ years to show you their experience. And this is assuming the market just stays flat. And we see 3% appreciation in real estate, which we know on average that's a safe estimate or assumption, but we know 3% doesn't mean you get 3% every year. We're going to see 8%, we're going to see 0, we might see some negative, like real estate's going to do this. So oftentimes we take advantage of that and we can accelerate this plan by timing the market the right way. Just like we did, and you'll see some examples later today in Phoenix and Las Vegas, where we bought when they were on super sell and then we were able to go up.